equity markets have delivered some powerful performances so far this year, but are investors positioned to benefit from this development? Joining me today to delve into the role of equities and how equity markets are performing in more detail is Fund Manager Shaun le Roux. So Shaun, firstly, can you maybe provide a macro overview for us of how we got here and highlight the role that equities can play in client portfolios?
Hi, Audrey. Yeah, it has been a powerful year for equities, and I think that surprised most of us, given the global upheaval, given all the noise around tariffs and the Trump administration, and given the fact that the world feels like it's embarked on a new era, one that where international relations are being reshaped. It surprised us to see how well equities have done, and the macro environment is one in which we think the old world order is busy changing. And the key feature of the world of the future, which we think investors need to be thinking about, is we think they need to be preparing for more global inflation. But importantly, equities generally like inflation, and the ingredients of the global macro environment that we think are likely to give rise to more inflationary conditions than otherwise. Protectionism or tariffs would be a big part of that. The fiscal deficits that have been run in the West are contributors. And we think you also need to be looking at things like the weaker dollar, tight labor markets, et cetera. So we think it's understandable why equities are doing so well. But if we look into valuations in the broader market, and particularly with respect to the US, we would have some concerns.
So can you explain to us why it is that you feel that local equities are actually very well positioned when we compare them to US equities, and how investors should be positioning themselves to capitalize on this?
Yeah, 2025 has been a really interesting year. If we look as we stand in Rand terms, South African equities are up around 35%, and US equities are only up 3%. And we started the year with everyone all in on US equities. The US economy is roughly a quarter of the global economy, yet almost 2/3 of global equity investments are in US equities. So there's a very disproportionate weight towards the US. And it's partly to do with the fact that the US market has done so well over the last 15 years. The narrative has been this concept of US exceptionalism. And if we look into South African investors, they've bought into that narrative. So they've been quite keen to externalize their assets, and we've seen far more demand for global equities than local equities. And one of the other ingredients is that South African investors, given their negativity towards the local stock market, have actually been quite conservative in terms of how they've approached their capital allocation. So the stock market performance in 2025 has surprised them. And we get a lot of clients saying, but the South African economy is doing poorly. How are South African equities doing so well? And we think what they lose sight of is that the South African stock market, or the JSE, is not SA Inc. It's not a representative of the South African economy. In fact, the SA Inc. shares have lagged this year. And importantly, precious metals and other commodities have done extremely well this year. And it's worth remembering that commodities have a big bearing on how our stock market and our economy do. But also we think it's worth remembering that that macro environment that I spoke to earlier, which is, we think, a changing of the order, we think it's time for investors to start preparing for a weaker dollar and a passing of the baton from a growth perspective from the US in particular to places like emerging markets. And we think we're entering into an era where emerging markets do better And we think that will benefit the South African economy. And very, very importantly, if we compare the valuations that are available in the West, and particularly in the US, to the valuations in a market like South Africa, our market is dirt cheap. It's incredibly cheap, and as you know, PSG prefers to invest in out-of-favor places. We like to buy at a margin of safety, and we think the odds are starting to weigh in the favor of people that are prepared to invest in something unloved like the JSE.
So looking at the current environment, is there anything that concerns you, that you're worried about? And what do you think should investors be paying attention to at this time?
So we're going into a new global world order. Frankly, none of us know what this means. Frankly, none of us know what Mr. Trump is going to tweet tonight. So for any of us to express too much confidence is not a good thing. What we should be worried about is the positioning and valuations in the most crowded part of the market, and specifically referencing the US, specifically referencing anything connected to AI. We see tremendous hype in that area. We think it's very, very unlikely that that hype will be matched by economics. So we think people should prepare themselves for significant disappointment. And when we look at the extreme levels of positioning in US large cap equities, and we look at the valuations that are a consequence, we think it's extremely unlikely that that part of the market will generate the returns that they've been in the past, or the returns that people seem to be expecting. So we think you need to be worried about that. And we think the way to be thinking about that is to be positioning your portfolios or your assets in areas where there's not a lot of good news priced in. Because what that means is that if things aren't great, you get a lot of support from valuations. But if the valuations are very high, and we think in some cases in the US, there's some bubble-like characteristics, you're more than likely to be disappointed.
So maybe to bring it back to PSG Asset Management's approach, do you see any advantages to our particular way of looking at markets and exploiting those advantages that we do see for our clients?
Yeah, I do. We bottom-up stock pickers. We are prepared to invest in unloved, out-of-favor parts of the market. And as I suggested, in this very, very concentrated world that we find ourselves in, if you're prepared to look beyond what is loved, there's a very fertile ground for stock picking. And we can find exceptional opportunities in this environment. Some of them have started paying off in 2025, but we think it's just the start. We think this is a long-term story that's building, where that massive pool of money that's concentrated in a very narrow space will need to migrate into other areas. And we think it's an environment that should be very beneficial for our clients.
Shaun, thank you so much for joining me today and shedding some light on what's happening in equity markets.
Great pleasure. Thank you, Audrey.
Thank you.